So welcome to this webinar about how senior professionals read financial models in for real estate investments. Okay, my name is Maria Widner. This is going to be a 30-minute webinar, and I'm delighted that you are here. And I hope this brings some light into how we are using financial model. No, this session is normally I teach the webinars how to build financial models or different ways to set it up. But now in this class here, this webinar, the idea is how you read financial models. So it's not so much like how you do things on the financial model, but then like once the output is there, how are we going to analyze it and how are we going to check if this is correct, how are we going to make sure that this aligns with the investment thesis that you're proposing to your client or to your boss or yourself if you're doing this by yourself. Okay, so let's get started. I'm gonna share here screen. Okay, so let's see here. I hope everyone can see okay. So how senior professionals read financial models. So normally when we go to board meetings and then we start to inquire about the investability of the project, does it make sense? Are we going to see profit enough, and so on and so forth. When we're going to look at the KPIs, right? And then one of the main ones, if not the main one, is the IRR. And then it comes across, and this is with anything. Is it gross or net? Is this after tax or is it before tax? Is it using just the rent divided by the yields, and then as for the exit value? So there's lots of like questions that may arise in the meeting. So we need to make sure that we are prepared for those if you need to answer them, or if you are the senior professional, then you get the answers that you're looking for. So the idea of a financial model of the whole investment case is for us to feel comfortable that this is a project that is not going to fail, that this is something that we're going to put our money in and we're going to see our money out with the profit with it, and hopefully the target profit that we requested. Okay, so the session is about reading the model rather than building the model itself. And I think for you in this webinar, it's important that you understand what reading the financial model is, especially now with AI, because you need to understand that if this is just something that it was put together by AI, or if this is something that doesn't make sense at all, if the formula is there, just you don't know where it's coming from. So reading it and making sure that you can spot the mistakes and you can spot what the investment flaws are. This is very important, especially now when people are moving more to less doing it and more to thinking about it, which is a great thing about AI, like how you think about the investment analysis with the feel of a financial model. Okay, so let me go to the next one. So with this 30 minutes, so we're gonna do the introduction. We're gonna start from the outputs, working backwards into assumptions, forming a view quickly, and Q&A and close. Please, if you have questions, just put on the I think there is a chat or there is a Q&A in the session there. So please just send your questions, and I'm happy to stop, especially because me, I like to for this to be very interactive, because it's not only a webinar that we're going to post on YouTube, but also it's a chance for you to ask your questions and hopefully get some answers. Okay, so we need to start from the outputs. Okay, so normally we're going to open our financial model there and then lots of spreadsheets depending on how complex it's going to be. But normally senior professionals, they're going to go straight to what is the IRR, what is the equity multiple, what is the return on equity. If it is development, what is the profit on cost? Okay, so you need to be very comfortable with those KPIs, what it means, not only like, oh, the return on equity needs to be 20%. But you need to understand where this, what is the basis of this equity? Okay, so like it's a return on equity. Where is the equity? Where is the equity starting? Is the equity starting from the beginning of the investment, or sometimes like we're analyzing companies and then the return on equity is just an annual return on equity, so it's somehow like an annual IRR. So you need to understand what those KPIs are. So the first thing is, when we are opening our model, the answer that we need to have is, are we going to buy or not buy? Are we going to sell? Like, you need to be very clear about what are the KPIs that you need to look at in terms of making this decision. Okay, so these are the main ones. So if you're not familiar with those, I suggest you should really look into the IRR, how IRR is calculated, and especially like if it is post-tax IRR, pre-tax IRR, post-promote IRR, pre-promote IRR, like all this you need to be very comfortable with. Equity multiple, it's very important as well, because sometimes investors might just look at an equity multiple. So they were going to say, okay, I need 2 times my equity multiple. It doesn't matter how long it takes, but I want you to just make sure that you return my money times 2. So you're like double my money. Net present value, even though if you come from a finance background, if you have done business school, you will know that when we come out of finance classes, we always say like, okay, I promise I'm going to make all the decisions based on net present value. But then when we come to real life, the net present value is kind of like overseen. So we don't really talk about net present values, but it's very important, especially when we are going to think about bidding for a site. Okay, so the bidding of a site is very dependent on the net present value, because you should not bid more than what the NPV is telling you. Okay, return on equity is the same as an equity multiple. But it's just that sometimes people say, okay, I want a return on equity of 30%, and then if somebody says a return on equity multiple of 1.3, you need to understand that this is the same. Okay, so but it's just that they appear as complementary, but they actually have the same information, the same as IRR and NPV, like they will kind of give you the same results. But it's just that some people are more comfortable with return on equity, some are more comfortable with equity multiple, but these two are the same measures. Okay, so the first impression. So IRR. So you need to understand very well what the IRR is. It's not only a matter of me telling you it has to be 10% or 15% or so on and so forth. So IRR is this annualized return on invested capital. So it can be, so sometimes I have this discussions in meetings. Is it gross or net? I always clarify, because that happened before that I was in a meeting with some developers, and then so it is IRR. Is it post-tax, pre-tax? Is it post-promote, after promote? And then I had 2 answers at the same time in the meeting. So if you are raising debt or equity, you need to make sure that it's not you that is going to get into this situation. When people are looking at the IRR, so then they will have the threshold, so to say. So for very low risk, low return, some people are looking at around 8%. So very core investments, low return, like a low leverage. But that's the minimum. I would say. And then the more you go up the risk criteria, for example, core plus, value add, opportunistic investments, then this IRR need to follow this pattern. So the higher the risk, the higher the IRR. And it's not only the risk, the physical risk, development risk, or asset risk that it's important, it's also the financial risk. So how leveraged your investment is. And on the leverage is not only the level of leverage, but also like what is the interest rate? Because if you have very high interest rates, then it means that you're pretty risky. Like if anything goes wrong, and then you have locked in a very high IRR on the debt side, then it means that it is a very risky business. So you need to be careful with that as well. Equity multiple. So the equity multiple is this idea that, if you're going to buy for 100 and sell for 200, you double your money. So your equity multiple is 2. One thing, my criticism in equity multiple, so if you have come to my class, you probably have heard me saying that we shouldn't use equity multiple because it's very silent on timing. What does it mean? Because if you buy for 100 and sell for 200, it sounds great, like you double your money, but one thing is doubling your money in, say, 5, 7 years. The other thing is doubling your money in, say, 20 years, right? The outcome is also the same, is the same. So you're going to have a 2 times your equity multiple. But one thing is returning this multiple in a shorter period of time, and rather than returning the multiple in a longer period of time. Okay. So this cash drag is something that you need to be very aware of. We have the net present value, which is the surplus above the required return threshold, and positive is the minimum bar, must be positive at the discount rate. So the net present value is the way you put it is that the net present value is the same as your profit. The difference between profit and net present value is that the net present value is discounted by a target rate. So the idea of net present value is how much extra you have in terms of profit, assuming that you're going to take into consideration the cost of capital, this target rate. Okay, so if you have a positive NPV, it means that you will return your required return, so say 10%, you still have like 10% return. And then the net present value is the extra profit you're making after you have returned the capital plus the interest plus depreciation. Okay, so that's the idea of, whereas the profit itself, if you buy for 100 and sell for 200, the profit doesn't change. It's always going to be 100, whereas the NPV will change depending on how long this sale might happen. Okay, so that's why I always say that, like in development, people don't put NPV, don't put IRR, because if they were to put, they only talk about like profit on cost or equity multiples. Because if they were to put like in financial terms, IRR and NPV, it would never make sense because there's always delays, and the cost of the interest rate increases. And not only because interest rates increase, but the more it delays, the more you have to pay interest. So all these things need to be taken into consideration. And then the return on equity is the same as the equity multiple. The difference is that you need to add 1 on from the return on equity to the equity multiple. So if your return on equity is 30%, so in this case, like, you bought for 100 and sold for 200, so then your return on equity will be 100%. Yeah, so you buy for 100 and sell for 200, so you have like 100% return. But then it means that your multiplier is 2 because, for each pound, each euro that you put in, you're going to get 2 times back, but your return on equity is 100%. Okay, so this is the idea of you looking at the first page there and saying, okay, this is what I need to look at in terms of the KPIs and if this makes sense. Okay, so it's pretty much going straight into the KPI and say, well, does it fit my investment profile? Then once you know that it fits, so you say, okay, there's enough bone, meat on the bone that people say there, then you need to work backwards into assumptions and say, okay, does it make sense, this assumption, or are they like very optimistic? Because if they're because being pessimistic, like normally we have some comfort that there is an upside. But if you're always very optimistic, then you need to stress test this. What is this? What is this? How optimistic you are? How you are going to what are you going to do in case there is a shortfall in whatever it is there, like in capital, in case there's the interest rates go up, in case the yields soften, in case the rents don't grow as much as you have underwritten in your model. Okay, so you need to work backwards and see where the problem may lie in the future. The the exit yield is the most important input in the model because it before you invest anything, you need to know how you're going to get out of this investment. So it's a bit counterproductive because you're like, okay, I'm going to go in, but thinking that I need to go out. So you need to make sure that when you invest, and then you need to say, okay, what is going to be the sale price in the future? So it's like before you even put £1 when you're in, you need to have this idea of what you're going to sell at the end. Okay, so the exit yield is very important. And then because the exit yield, it drives how much you sell for at an exit. So you really need to stress test this. You need to think about what is good, what is the minimum that you can sell for and still make a profit, still make your required return. Okay, and see how realistic this can be. Because if it's too optimistic, if you think, okay, the value of my property needs to double in 3 years' time without any capex in this, then you know that this is too optimistic. You're not gonna, achieve the IR that is shown in the first page. So you need to understand what is shaping the exit yield. So IR exit yield is pretty much shaped by interest rate expectation. Okay, so you have to think about it as well. What do you think the interest rate is going to be? Because the yield interest rates are they are pretty much this, I would say 100% correlated. Affected by depreciation and long-term rental growth. So you also have to think about what is the impact of depreciation on your exit yield, because property will always depreciate. Land doesn't depreciate, but property will always depreciate. So if everything is the same, nothing happens. Interest rates are the same. Rental growth is the same. Your building is going to be older. This alone will make your exit yields be higher. Okay, without any yield shift, without any rental growth shift, it means that your interest rates are good. Your building will have to increase. Rental growth. So if you think that the rental growth is going to be from, like you buy at the bottom of the market, hopefully now, and then say, okay, there's going to be massive rental growth, then this rental growth will have an impact, a positive impact on the yields. The positive impact means that it's the higher the growth, the lower is going to be the exit yield. Okay, so say like everybody's assuming 0% rental growth, but then you're going to put in your model, I think it's going to be 2% rental growth. This rental growth, and then the perspective, that this is going to be carried on after you sell the building will have a positive impact on their yield. It's going to go down. Your yields down, price up, and then your sale price is up, then you're going to make more profit. So you need to think about this rental growth as well, how it's going to shape it up. And then don't forget that the rental growth is also impacted by depreciation, because it might be that in the first years you might have like very strong rental growth, but then as the building depreciates, then your rental growth is not going to be that high. So you have to be mindful of depreciation, both in terms of the exit yields and on the long-term rental growth. And then, of course, you need to do the sensitivity analysis, thinking about, like a 25 basis points, 0.25% can have a massive impact on your IR. So you need to stress this and then make sure that you understand where your risk lies, like how much interest rate needs to go, your yield needs to go, your rental growth needs to go in order for you to make your money back, and then test this if that's um, if you're comfortable with these assumptions, okay? The equity multiple trap, and that's what I said in the previous slide, which is the 2 times looks identical, the IR is completely different. So for example, here you can have an exit in 3 years time, equity multiple of 2, 20%, 26% IR. If you have an exit in year 5, you can still have a multiple of 2, but then your IR is 15%, year 10, still equity multiple of 2, and then an IRR of 7.2%. So this is really for you to think about what is this idea of equity multiples and IRRs. Okay. Forming a view quickly. So you need to, I think this is the main challenge with financial model, because you need to pick the values there that interest you, form a view quickly, understand the assumptions, and make a decision. I think this is the key to, being a senior professional in real estate, that you have to make decisions pretty quickly and informed decisions. So you need to be able to read financial model. You need to read to understand the investment case, and if the investment case and the model they align. Okay. So assumptions are everything. True valuers, true investors, they can have the same financial model, the same information, but they can come up with very, very different values at the end. Even if you are not an investor, you're a valuer, for example. Even the valuation, even if you do the same model for the same property, you may come up with very different results. And this is because the assumptions, okay? So you need to make sure that these assumptions are very well highlighted in financial models. You can stress test this, and if anything happens, then you can justify why you're different, why you are different from your colleague, or why you're different from another company. 3 questions every senior reader answers is, does this return make sense for the risk profile? So this is very important because like if this doesn't make sense, if the building is too expensive for you, the returns are not there, it doesn't fit your requirements, then you're just gonna say, okay, this is not for me, and then you closed it, and then like next investment. So you need to have an idea of what your strategy is. So if you're going to be core, it's going to be lower risk. It's always going to be there. The capital value is not going to change. The yield's not going to change. The rent is always going to be pretty much the same. Like maybe it will increase 10%. Like if you're, Resi West End might raise, it might increase 10% from 1 year to the other. Not always, but it might be. Because we have very short supply. But you have to think about what is your investment case, right? What is your brief and your mandate if you're working for an institutional fund? What is your mandate? So then, if those things, if this IR makes sense, if this equity multiple makes sense, if this profit on cost makes sense. The assumptions, are they defensible? So that's what you need to look at. And this assumption be defensible is kind of like one thing that you learn going, facing a lot of market cycles, and also different asset classes, because you're gonna get it sounds terrible, like you get a feel for what is right or wrong, because like if people say, okay, I'm gonna put I'm gonna get a mortgage of 90%. It's like you're not gonna get it. I'm going to get like I'm gonna pay only interest and I'm not gonna amortize. No, that's not the case anymore. So you kind of know like the scenarios that are plausible for the investment cases. Um, and then what would break it, right? So then identify the single biggest risk is interest rate sensitivity. So when is interest rate sensitivity a big risk? Well, if you're in a floating rate, 90% leverage, even, you might get like a whole loan for 90%. Then, like interest rates changing a little bit might, kill your project already. The planning risk. Planning is always a massive risk, but some people are prepared to take planning risks. So they might have like this quiet capital that will sit there, and then they're gonna say, okay, it's gonna take whatever it's gonna take, but we are prepared for it. This is the amount of capital we can put in, as long as it you know, doesn't go beyond this budget, then we'll wait, right? But some people will say, okay, assuming that planning is granted or that is going too easy to get or something like this, you need to be very, very careful with it and very and able to scrutinize. So always like when you are doing investments, you're not going to know about every market. You're not going to know about any planning risks in different parts of the country or different parts of the world. So you need to also ask for opinion of the people on the ground. So that's what makes also property different, because it's not, even though it's a global market that capital moves from cross borders, you need to get on the ground advice. You need to talk to the people there, they understand the market, they understand the rules and regulations, they understand consumer behavior, they understand how the politics, the economics work, because this is one area that we need to feel comfortable. Can you build what you want to build? Can you sell what you want to sell? Can you borrow the way you want to borrow? So you need to get those advice in place, and then identify what is the risk. It might be that, what happens if the contractor goes bankrupt, or what happens if, you expect to get a license for, um, for operating a hotel or a convenience store, whatever it is, like what happens if you don't get those things? Like what is the plan B? Yeah, what it looks like with the plan B as well. So build the answer before anyone else asks it. So it's good to have this idea of like what the questions are. You can't answer all the questions, like how much you're gonna sell for. Well, like you need to have at least some idea of like what is being selling for now and what sold before in a similar cycle in the past, and then you can have some defense that this is the right thing for you. Before you leave a model, and then so that's the thing, like outputs, assumptions, and then the decisions. So this is pretty much what we've discussed. So that's just a checklist for you to use. Like the answers that they have you thought about those? That structure, is it floating or fixed? Are you hedging it? Void periods, lease expiry, have you modeled those? And then the decisions. Can you articulate the decision? Can you defend the decision? And that's how you go from just building models to actually reading the models and actually making the decisions. Okay. So just don't be the expert in building it, be the expert also in reading it, making decisions, or giving recommendations on those decisions. Okay, so the last slide here is that the model is a story. Okay, so our job is to read it faster and better than anyone else in the room, as financial model, financial analysts, financial advisors, and we need to tell the story of this investment very well, and understand the numbers, where the numbers are coming from, where like what can break these numbers, and then form a view of the risk, but also the returns. And last but not least, I don't think we have questions here, but if you do have questions, please send them our way. These are my contact details. You came through from our mailing list, I think, so you know where to find us. But if you need anything, please let us know. As I mentioned, please join our next webinars. Please ask us questions and come to the our courses as well. We have fully, on demand, or if you want to book one-to-ones, please let us know. We're here to help you with this with your career and how you're going to move forward as well. Okay, so thank you so very much for joining. I hope it was helpful in clarifying what you need to look at when we're doing your financial analysis. And it's great to see you all here. And I see you next time. There's another one on Thursday because I couldn't make it the last webinar, so we scheduled this for Thursday. So if you have time on Thursday, it'll be great to see you all again. Thank you so much. I'll see you at the next one.